In today's episode, I will talk about two very interesting stories. In the first story, I'll talk about Reliance's latest quarterly updates and what insights we can draw from it as investors. And in the second story, I'll talk about the latest Nobel Prize in economics and why you and I should really care about it. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest financial news for you in a way that is one level deeper and more comprehensive as compared to news channels. I'm your host Anurag Bansal, and today is Wednesday, the 16th of October. Let's begin with the first story. I'm sure all of us watching or listening to this podcast know how massive a force Reliance is across almost every aspect of India's economy. Whether it is energy, telecom, retail, or even the growing green energy sector, Reliance touches and almost dominates all of these places. Reliance's scale is absolutely massive, and the kind of size and scale that they operate with does not only make India's market what it is, but also affects global trends. From the petrol you fill into your vehicle to the internet service you use on your phone to the groceries you pick up from the local shop, Reliance has its arms and legs pretty much everywhere. Recently, Reliance released their quarterly results, and given the size and scale that they operate in, their results almost always have interesting insights and trends for us to learn from. So, in this story today, let me break things down and simplify things as much as possible. Let me start with Reliance's overall financial performance. They reported total revenues of 260,000 crores in this quarter, and this is about 1.2% higher than the same time last year. Now, this is a small improvement, but despite this, their EBITDA, which is a key number used to measure profitability, fell by 1.7% to 44,500 crore rupees. Reliance's profit after tax or PAT also dropped by 3.2% and it was at 18,700 crore rupees. So while their sales went up slightly, their profits took a little bit of a hit. Let's now get into the specifics of Reliance's multiple businesses, starting with the biggest one, which is oil to chemicals or O2C. Navigating global market pressures, Reliance's largest business, which is oil to chemicals, saw revenues grow by 4.8% to 1,58,300 crore rupees. But the downside here is that their EBITDA for this segment dropped by 22.5% to 12,000 crore rupees. The question is, why did this happen? Look, one major issue here is that Reliance's margins have been squeezed. I'll explain why this is happening. See, there is something called the fuel cracks, which is basically the difference between the price of crude oil and the refined products that come out from it, like petrol or diesel. The margin here has dropped by a massive 45% compared to last year. Now, this is mainly because of weaker demand globally and an oversupply of oil products, which are pushing prices down. Another big reason is the slowdown in China's economy. China is a huge buyer of oil, but demand there has fallen because their economy is not quite growing as fast as it used to grow. Plus, electric vehicles or EVs are catching on very, very quickly in China, which is also cutting down fuel demand over there. Now, interestingly, if you would have told your friend just 2 years ago that EVs would have such a massive impact, they would have definitely thought you were joking. But today, we see that as a reality. Moving on, let's talk about Reliance Jio, which is Reliance's digital services arm. They had a very good quarter with revenues going up by 17.5% to 37,500 crore rupees. The EBITDA here also grew by 18.2% to 16,000 crore rupees. Jio's average revenue per user or ARPU, which is how much each customer spends, went up by 7.2% to 197.5 rupees, all thanks to the recent price hikes. To give you a small comparison, Airtel's ARPU stands at 210 rupees, so Jio is not really far behind anymore. But that said, Jio lost 1.1 crore subscribers this quarter, which dropped its total user base to 48 crore people. The reason was mostly price-sensitive customers leaving after recent price hikes. But the silver lining for Jio in all of this is that they are able to focus more on customers who are willing to pay more for better services, and this has helped them increase their ARPU despite subscriber losses. Jio's 5G rollout is also moving very, very fast. They have 15 crore users right now on their 5G network, which accounts for 35% of their total data traffic. Jio has also launched the Jio Air Fiber, which is a new broadband service which has already reached 3 million homes in just 6 months. This makes it a big game changer for areas in India with limited internet access. Moving on, Reliance Retail saw a slight revenue dip of 1.3% and earned about 76,000 crore rupees in this quarter. The fashion and lifestyle segment had a very tough time, mainly due to weaker consumer demand. But overall, retail business of Reliance still looks very, very strong. They opened 470 new stores in this quarter, which brought the total number of their stores to 19,000. They also shut down 430 underperforming outlets in order to streamline their operations this very quarter. Ajio, which is Reliance's online fashion platform, is growing very, very fast as well. They're adding 20 lakh new customers and expanding their product line by 30%. They're also adding popular international brands like H&M and Zara to their portfolio in order to attract a younger crowd to themselves. And they're positioning themselves for a longer term growth trajectory here. So Ajio as well as JioMart will play very, very key roles as Reliance expands their digital and physical retail offerings. Moving on from that, let's talk about Reliance's oil and gas segment. Now, this segment is smaller than the O2C business, but they still had a great quarter. The revenue dropped by 5.5% to 6,300 crore rupees, but EBITDA jumped by 12% to 5,500 crore rupees. This boost came from higher production in their KG-D6 basin, which helped offset some of the lower gas prices. This business, though is very small right now, is becoming a very crucial part of Reliance's energy strategy. Next, Reliance is also making big moves in the green energy space, which is very, very key to their future plans. They expect their new energy business to be as profitable and big as their O2C business in just the next 5 to 7 years. And their investments of 75,000 crore rupees into this area also speak the same. By the end of this year, Reliance is planning to start producing solar photovoltaic modules with a capacity of 10 gigawatts. But they're not just stopping at solar panels, they're also building a whole ecosystem, so to speak. They want to produce everything from raw materials to finished panels. Reliance is also working on a huge battery manufacturing facility in Jamnagar, which is expected to start operations as early as next year. This Jamnagar plant will have a capacity of 30 gigawatt hours. They're also looking to set up a green hydrogen electrolyzer plant, which will start production by 2026. All of these projects show Reliance's commitment towards becoming a major player in renewable energy. Then there's also Reliance's media business, which took a small hit this quarter. Their revenue was down 2.5%, more or less due to lower movie revenues, which can be unpredictable if you think about it. But their digital platforms still continue to grow. Jio Cinema, which is their streaming service, has gained 1.5 crore subscribers in just 100 days after launching its paid subscription. A new deal with Disney is expected to further strengthen Jio Cinema's position in India's currently crowded streaming market. So, to summarize everything, while Reliance is facing some challenges, especially in its core oil business due to tough global conditions, they're managing these issues very well by focusing on growth areas like digital services, retail, and renewable energy. Reliance is pouring in 35,000 crore rupees in investments in this quarter alone, which shows that they're committed to long-term growth. But that said, Reliance's debt has also increased to 1,17,000 crore rupees, so that is something to watch as they continue expanding further. Moving on, in the next story, let's talk about why three economists recently won the Nobel Prize and what their findings really were. This year, the Nobel Prize went to three economists, Darren Nismoglu, Simon Johnson, and James Robinson. They studied a big question: why do some countries become wealthy while some others do not? Their answer focuses on institutions, which are the rules, laws, and systems that decide how a country's economy works and how its people really live. Now, you might be thinking, why should I care about the 2024 Nobel Prize in Economics? Well, it actually deals with the questions which impact our everyday lives. The three winning economists believe that the answer lies in the systems that run a country, which is things like its laws, government, and who holds power. Their research shows that these systems or institutions play a huge role in deciding whether a country does well or struggles. By understanding their findings, we can see why inequality continues in the world and how better leadership as well as governance could help create a brighter future for all of us. Now, these economists found out that countries with strong, inclusive institutions tend to do better. For a simplistic understanding, inclusive institutions mean that most people have rights, feel safe, and can take part in the economy. Things like owning property, having fair local governments, and having chances for people to improve their lives are all a part of this. On the other hand, countries with extractive institutions, which is where power is held by a small group of people and the rest have very few rights, usually do not do well. The researchers looked at history, especially the time when European countries were colonizing different parts of the world. When Europeans took over land, they faced different kinds of environments. In some places, the weather and living conditions were good, so they settled there and built communities. In the other areas, they created institutions that helped the economy grow further. These are called inclusive institutions because they have let many people take part and benefit. But in places where the environment was harsh or dangerous, like areas with diseases such as malaria, etc., Europeans did not quite want to stay long over there. So instead of building communities over there, they focused on taking resources like minerals or spices. They set up systems which gave power to a small group of people while the rest of the population had little or no control whatsoever. These are called extractive institutions because they were designed to take things out without investing in the local people. The effects of these two approaches are still very, very visible in our society today. Countries where inclusive institutions were set up tend to be wealthier because their systems encourage people to participate as well as improve their lives. On the other hand, countries that were left with extractive institutions have quite struggled. This is because their systems gave power to only a very few people and made it very hard for others to get ahead. In this way, decisions made during colonization continue to shape whether countries are rich or poor today. One interesting idea from their research is the reversal of fortune. This means that places that were rich before colonization, like parts of Latin America, are now poorer, while places that were poorer back then, like the US or Canada, are now much wealthier. This change is linked to the type of institutions that were created during colonization, whether they were designed to help the settlers or just to extract resources. Now, of course, like everything else, not everyone agrees with the economist's findings. So let me give you a very quick rundown of three main criticism points. First, some critics say that it is very hard to prove that institutions are the main reason for economic growth. This is because institutions do not quite exist on their own. Historic events and decisions shape them. So do strong institutions lead to wealth, or it's the other way around where countries become wealthy for other reasons like having better resources or education and then build better institutions? It's very hard to tell, and this makes it very difficult to say for sure what causes it. The second point of criticism was about the data that these economists use, especially around settler mortality rates. See, the researchers used this data to argue that places where Europeans could easily settle up ended with better institutions. But some critics are saying that the data from the time is not very reliable, especially from regions like Africa, where the records are pretty much inconsistent. This makes it hard to be sure about their conclusions, even though the researchers try to fix these issues. The third criticism point is something called the exclusion restriction. The researchers assume that the only way settlers' mortality affected today's wealth is through the institutions that they set up. But some people say that settlers also bought skills, education, and knowledge, which pretty much helped shape the economy directly. So, was it the institutions that helped these places succeed, or the skills of the people who settled there? This makes it very tricky to say which factor played a big role. Now, at a recent press briefing, Ace Moglu explained that inclusive institutions are not just about having rules in place. They also need to give everyone a fair chance and create an even playing field. This includes things like property rights, education, infrastructure, and good regulation. Political inclusion is also very important. It means making sure that power is not controlled by just a very few people, but is shared so that everyone has a say. The link between economic and political inclusion is what helps countries grow and stay strong. Despite all these criticisms, Acemoglu, Johnson, and Robinson's research has had a big impact on how we think about economic growth. They've addressed some of the issues with their data, like problems with settler mortality, and have made adjustments to their analysis. They also recognize that education and skills are important alongside institutions. Even with multiple debates, their work has changed how we understand and why some countries succeed while the others struggle. At the same press briefing, Acemoglu and Johnson also talked about the challenges facing democracies today. Public trust in democracies are low and political division is rising today. While democracy hasn't always lived up to expectations, they believe that it still offers the best path to shared prosperity as well as freedom. Democracies tend to do better when they offer fair governance, equal chances for everyone, and good public services. They are hopeful that democratic institutions can renew themselves even during tough times. So, the key takeaway in all of this is that institutions really matter, but so do things like education, skills, and good governance. A country's success is not just about having good rules, it is also about how those rules are used and how societies can change over time. The chairman of the Nobel Economics Committee said that closing the huge gap in income between countries is one of our biggest challenges. Acemoglu, Johnson, and Robinson have given us a clearer understanding of why some nations succeed while the others do not. They didn't quite invent the idea that institutions matter, of course, but they provided the evidence and analysis to show just how important these institutions are, which makes them truly deserving of the Nobel Prize. Now let's move on to the final section of the day, which is the small news tidbits. First, in the third round of India's PLI scheme for white goods, 38 companies have applied, including Voltas, Daikin, and Orient. This scheme is meant to boost local production of air conditioners and LED lights. It will bring in 4,121 crore rupees in investments and will create about 48,000 jobs to help increase local manufacturing. Second, Bharti Airtel has made deals worth over 10,000 crore rupees with Ericsson, Nokia, and Samsung. These deals will help expand Airtel's 4G and 5G networks in India. Airtel plans to add more 4G towers and a few 5G stations as well. This move will strengthen its market presence and improve revenue per user. Third, Oyo is planning to raise 200 million US dollars to buy G6 Hospitality, which owns over 1,500 budget hotels in the US and Canada. This would increase Oyo's value to around 4.5 to 5 billion US dollars. At the same time, Oyo is working on refinancing 450 million US dollars of its debt. Fourth, India has now reached over 200 gigawatts of renewable energy capacity. This makes up about 46.3% of the country's electricity generation. Solar and wind are leading this growth, and India is getting closer to its goal of 500 gigawatts by 2030 by improving energy security and by creating jobs. That's all the news and stories I have for you today. I hope you found today's episode valuable. Would love to know your thoughts in the comments below. This is Anurag Bansal signing off on behalf of the Daily Brief team. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.